I think it's mine.
All right, everybody.
Hello.
Hello, hello.
Matt?
Hi.
That's impressive.
Yeah. Well, thank you all for joining. Just a couple of housekeeping notes. We are recording this session. There's a Zoom camera up there, so if I look at the wall, I'm not crazy. I'm just kind of acknowledging the people who are attending via Zoom. Thank you all for coming. My name is Matt Greer. For those of you who don't know me, my title is Finance and Operations. I've been with the Community Foundation for just about 4 years. I think it's 4 years in 3 days. So on behalf of the Charlevoix County Community Foundation, I want to thank you all for being here. It's truly inspiring to see a group of this nonprofit leaders and volunteers, donors, and community partners gathered. Whatever walk of life you come from today, a nonprofit, a donor, a community partner, your presence here reflects a shared commitment to strengthening our community. We know how busy everyone's schedules are, so we're truly grateful you chose to spend this time with us. I'd like to extend a special thank you to our team at the foundation, the staff of the Charlevoix Public Library, and everyone else who helped bring this event to life. And of course, to Jeff Weisker, who made the trip up from Cincinnati, Ohio to be with us today. As a community foundation, we have the privilege of working alongside nonprofits every day. Sorry, one second. We see the challenges, the creativity, and the resilience that define our community. And of course, it's hard to believe 2 months ago we were just beginning to recover from the ice storm. And yet here we are, continuing to show up, adapt, and move forward together. We also see the growing and changing needs in our community. And that's why conversations like the one we're having today are so important. Investing isn't just about growing wealth. For community foundations, it's about growing impact. It's about making sure the dollars entrusted to us by donors, partners, communities, and generations past are working as hard as we all are. At the Charlevoix County Community Foundation, we often talk about for good, forever, and the power of endowment. The idea that through thoughtful and intentional investment, we can support today's needs while preparing for the needs of tomorrow. So today, we want to pull back the curtain a little bit. Investments are a big part of how community foundations operate, but much of that work happens behind the scenes. The session is a chance to bring that work to the foreground and talk about the investment strategies that help drive the impact C3F makes in our communities. We are honored to welcome Jeff Weisker, a trusted expert in community foundation investment strategies. Jeff has worked with C3F for over 25 years and has been a steady, insightful partner through market highs and lows, helping us steward our investments with care and confidence. I was fortunate enough to be able to sit in on a presentation from Fund Evaluation Group yesterday, where Jeff gave a presentation of the 2025 Community Foundation survey results. It's a great resource that talks about trends in investing with community foundations and what we've seen over the past 10 years and where we're going to be going moving forward. So at the end, there will be time for Q&A after Jeff's presentation, and you're welcome to stay after that and talk with each other and our staff. So with that, help me in thanking Jeff for coming and welcoming him.
What a beautiful day to be in Northern Michigan. I mean, geez, I drove up yesterday right after the webinar, and I stayed over in Gaylord last night. And just to drive in this morning, we should be outside. We don't get that Cincinnati, it's so hot and humid, but thanks for having me here today to review just the overall investment program. What a year to have me up here. When you think of everything that we have been through so far this year within the capital markets, within investing, it's been quite the roller coaster. But what I've been telling all of my clients this year, this is why we do what we do in your portfolio. And we get into a lot of the details, but we put together portfolios that are diversified, that have multiple assets, not just US large cap companies like NVIDIA, but diversified, and we stay true to our and it's helping the community foundation. So as I go through my presentation, please stop me with any questions that you might have. I'd like to make this as interactive as possible. We got a nice group here today, so please stop me with questions. But the overall, you hear me okay? It feels like it's going in and out a little. Let me put it. Is that all right? Or?
Yes, my thanks.
Because I can hear it coming in and out. And it's out now. Bear with us.
You can count on it, technology.
That's right. Technology is great when it works. We're on take two here. And how about I just hold this? Is that better? Wonderful. And I'll just hold this, so don't mind me there. But the agenda today and what we will review is, first of all, just provide an overview of who we are and the purpose that FEG has on the overall Charlevoix County Community Foundation's portfolio. We'll then go into what I titled Endowment Investing or Foundation Investing 101. And this gets back to what Matt just hit on for good, forever, and why we diversify and have the portfolio that we do for you. We'll get into the investment committee's role. We have two of our esteemed investment committee members with us today. If you want to stand up and take a wave. And what they do on a quarterly basis to oversee the assets and the fiduciary responsibility that they have. We'll then get into some of the data from our Community Foundation survey. Now it says here 2024. The reason for that is we just had it yesterday. And so when I was preparing all this, our compliance department gets a little finicky about showing stuff before we mass produce it. There's one area that has grown in FEG, and that's been compliance. And then finally, we'll get into the performance in our outlook. So real quick, here I am smiling. It's good to know I have a different tie on. I said yesterday, still bald, beard's getting grayer, and I look more and more like my dad every day. But I've been at FEG since 1999 and have had the pleasure of working on your account essentially in one way, shape, or form or another since you came on to FEG around the 2002 time period. I served as an analyst on your account, and now I have the honor of coming up here on a quarterly basis and been doing that since the 2007 time period. So a little background on FEG. We're headquartered in Cincinnati, so I get to make the trek up north quite a bit. Let it be known too, it's not just summer when I'm up here. I am also here in the winter. Matt mentioned the ice storm. I was just absolutely amazed driving up here in middle of April and seeing the damage that did. I have a couple clients down in Asheville, North Carolina, and it somewhat reminded me of going down to Asheville after the hurricane and just seeing the destruction of the trees. So I know you guys all have been through a lot here since the end of March, beginning of April, but let it be known, I'm up here in the winter, even though I'm a snow wimp. We have offices in Indianapolis and down in Dallas. And one of the benefits to the Community Foundation that FEG brings is our experience with nonprofit clients. That's why we are in business. We serve nonprofits. Community foundations are one of our largest segments. We work with now 43 community foundations across the US. That represents assets of $6.2 billion. Why is that important for you? We can share with you best practices. We can share with you what other community foundations are doing across the US. We work with a number of them in Michigan. I have 10 community foundations that I work with in Michigan. So I am able to share with Matt and Sarah and the investment committee what the foundation might be doing down in Midland that could be interesting to you. Or just up the road in Petoskey or Otsego. So share with you best practices, help benchmark with you what others are doing. We're set up as an ESOP, so we're all owners at FEG, and we believe this is important to you in that we provide objective advice. We don't have a parent to report to, and all 135 employees at FEG, as long as you've been there for over a year, that we're all owners. And it's not just me. The committee sees me on a quarterly basis, but there is a deep team behind us. So enough on FEG, unless there's any questions about our firm. Yes, please.
Fill out ESOP.
Employee stock ownership plan. It's a defined contribution plan, so like a 401k plan. So it's basically the earnings are distributed on an annual basis, and it's in a retirement plan. No problem. Yes.
Can you repeat the question for the Zoom people?
Yes, the question is can you explain what an ESOP actually is? All right, Endowment Investing 101. Foundation Investing 101. When you look at the portfolio and just the investment program, the very first question, what are we trying to achieve for you? And what we are trying to achieve is intergenerational equity. Spending just as much in the future on a real basis as we are today. That's the whole concept of an endowment or a foundation. So the investment committee, your board at the community foundation are essentially the guardians of those assets. The whole for good, forever concept of endowment investing. Now, let's go back just to community foundations. Community foundations, the very first one was started in that other city in Ohio, Cleveland. The Reds just took 2 or 3 from the Guardians, so there we go. But the oldest community foundation was started way back, going to the 1900s. When you look at the FEG Community Foundation Survey, the average community foundation is 50 years old. The Charlevoix County Community Foundation, Sarah, Matt, how old are you? Close?
35.
35 years. And that's just fantastic when you think of your leaders that you've had in Charlevoix, in the state of Michigan. Michigan being one of the states with the most community foundations. Set up pool of assets to benefit the community in the future. All right, so that's community foundations. Now let's just look at the investment program. The very most important decision that the committee and then the board makes by approving the investment policy is asset allocation. How we invest the portfolios across stocks, bonds, and cash. When you look at all the decisions that the committee makes, that very challenging, but yet simple one decision is the most important. It's not from moving cash around. You can see here, it's not from market timing. I am not going to sit here and tell you that I can predict what the markets are going to do. I can't. You can't. There's no one that can consistently do that on a day-to-day basis. But what I can tell you over time, stocks outperform bonds, which outperforms cash. So the majority of your assets are invested in stocks. That's the most important decision. Timing. You look at, this is going back to 1926. So when we have data on the S&P 500, so large companies in the US, and you see just naturally upslope line. Again, for good forever, why we stay invested. It's not to say there's not big blips along the way. You go back to the early or late 90s, 2000, you had the dot-com bubble. You had the Great Recession. I remember coming up here in just a cold, snowy winter day in 2009 and talking about a portfolio that was down 30%. Not fun. But what did your committee do? Your committee stayed consistent. Your committee rebalanced. It was very hard. And ultimately, you were rewarded. So over time, stocks outperform bonds, which outperforms cash. That's why the majority of your portfolio is invested in stocks. And also with the timing, since it is forever, unlike our personal portfolios, which fortunately or unfortunately were not forever, we can withstand this volatility. And the markets have been resilient. And 2025 is probably one of the best examples of that as of late. We love charts in this industry. Here is probably my favorite chart that you'll see today. And this just goes to why we don't market time. This goes back to 1979, at the end of 1979, and says theoretically, if you had $10,000 and invested that $10,000 just in the S&P 500 index, so the index you always see quoted, what would your balance be at the end of March? Your balance would be 1.635 million. Look what happens if you miss just the best 5 days during that time period. So the best 5 days of the market. Think of what happened in the middle of April when the president pivoted on tariffs and the S&P 500 was up over 9–10%. If you take those 5 days out, that 1.6 million drops to 1 million. What happens if you miss the best 10? It drops down to 730,000. What a drastic difference between the two. That's, again, why we stay invested. The committee challenges us. Is it different this time? Do we need to react to tariffs? Do we need to react going back to the Great Recession and the housing crisis? But all in all, you have stayed true to that long-term approach. You've stayed invested because of this very data. You have to make two correct decisions to market time. The first one, when to get out, and the second one, when to get back in, because you need to embrace risk for what you're spending in the portfolio. So all the charts I'm going to show you, I hope you take away this one about staying invested over the long term. Questions, comments? And then this one. This is my second favorite chart. I nerd out over all this stuff. What does this tell you? Nothing. It tells you, we call this the quilt chart or the periodic table of investment returns. So this, sorry about that, calendar year on the top and performance of all the various asset classes that we track. And here's the takeaway: strong asset class performance is not persistent, and it's hard to predict year over year what outperforms. So what we do in your community foundations portfolio is this diversified box that tends to be in the middle. You don't get all the highs or all the lows. You tend to be in the middle. And when you annualize that out over time, you tend to be top quartile. So 2 charts take away: stay invested, and it's extremely hard to predict what asset class is going to outperform. So stay diversified. Questions, comments? That's the, call it Foundation Investing 101, and is basically the bedrock to everything we do for your portfolio. Yes.
Seen that plot of, you know, the total return less 5 days, less 10 days. Have you ever seen the plot when it's done, taking out the worst 5 days and the worst 10 days and what it's like? You know, obviously you can't.
Yes.
But, you know, it's like, if you just miss the worst days, you know, what happens to that plot?
And that's what's so tempting, because those blocks, think of how drastically different this was. Okay. If you take out the 5 worst days in the worst 10 days, that 1.6 million is going to be over 2.5. So that is the flip side. And that's why it is so tempting to try to market time. And we all know the down markets, they happen. You see bear markets typically every, 5 years-ish? And if you take out the worst 5 days, the exact opposite is true. You're going to look much better. And I've smiled because that's, you know, the flip side to my argument of staying true and not moving. But why it is tempting is if you miss those 5 days, your performance will be that much greater. It's just so hard to do. Because again, if you think of a foundation, what you're trying to achieve, it's a return greater than your spending. The foundation's spending about 4.75%, greater than admin fees, and then greater than inflation. So we estimate anywhere between 7.5% to 8.5% based on, you know, the range is because what is inflation at that point in time? So you're very correct. Take out those worst days and you look that much better. And here's the other noteworthy point. A lot of these best days happen during down markets. During bear markets, you have what we call the bear market head fake, where the market's up a good 10, 12% over the course of a very few short period. And those best days, again, in the down market, when you may be out, that hurts you quite a bit from that return. Excellent point. And that's, again, why it is tempting. Other questions, comments? All right, let's go to the Community Foundation survey. So I was joking with Matt, about 10 years ago, one of our clients was asking the question, how do we benchmark ourselves beyond performance? What are other community foundations doing in spending? What are they doing with asset allocation? What are they doing with environmental social governance investing or mission-related investing? So my boss came to me and said, we should do a survey. That was 10 years ago, I was a little younger. said, that's a lot of work. He's like, you're going to do a survey. And I said, well, I don't know if we'll get that many participants. So anyway, we started the survey. And lo and behold, it has become a great tool for you to benchmark yourselves versus the field. Another way of saying I was wrong. Should have done the survey right away. And you look at the data. So this is last year's survey. We had 107 participants. This year we had 113, which was an all-time high. Important for you too is 70% of the respondents are non-FEG clients. So you're not getting a biased view of our advisory shop. It's across the US. Last year we had 31 states. This year we had 30. I will say that Michigan and Pennsylvania are 1 and 2 neck and neck for having the most in the survey, usually about 10, 12, 15 for each state. So what we're able to do is to talk to you what others are doing. Community foundations are notorious for having a small staff. And you look at the data, 85% of the respondents have 1 or fewer individuals, Matt, for you, to help administer the investment program. Another reason why you have someone like us to help you the best we can to alleviate some of the back office questions, issues that Matt has to deal with. It's not his only job at the Community Foundation. What type of model do community foundations have with the advisor or consultant? The way we are set up with you is what we call this traditional non-discretionary model. You have a very active investment committee. They meet quarterly. So I make recommendations to the committee. They either take those recommendations or say, hey, have you considered this manager or this asset allocation? So it's a group discussion. I think you have 5 now on your investment committee. Nice small group, active in the industry. And that's why you've had this non-discretionary model where I don't have discretion over the assets, which we believe is good because community foundations are very unique, and trying to do a cookie cutter approach is not the best idea. Right up here, great example. I work with you, I work with Petoskey Harbor Springs, and I work with Otsego. You couldn't be all different. I mean, there's the adage, you've seen one community foundation, you've seen one community foundation. So we work as a group to come up with consensus decisions for your investment program. What are committees talking about outside of investments? Private equity investing is one of the most popular topics. We do not do that for you. Be happy from a back office standpoint, and also lately performance standpoint. The last 3 years have been a very challenging period in the private markets. Your auditors too would have some questions for us. Other topics that committees are talking about, impact investing. Another way of saying the portfolio that you have put together, is there a way we can utilize the assets from a grant making side to have more of a direct impact in your community? That is a hot topic across community foundations, and one that we are exploring with your committee. This year, legislative changes, this is last year. This year, that's one of the most popular. It's been very active in Washington in the nonprofit world. Most of it centered around private foundations and an increase potentially in a tax they might have to pay in the new tax bill. Also with just funding from, for some agency funds that you might have, funding being cut. So clearly talking about all the happenings from the legislative front. So again, this is the benefit of the Community Foundation Survey. We had our webinar yesterday. We will be sending out a replay of that next week. Matt would be more than happy to share the replay with you, just so you can hear our 45 minutes of talking about just macro issues and ideas for community foundations. Any questions on the survey? All right, the role of the investment. Oh, question. Oh, no, please. This allows me to get a couple, drink my coffee.
A couple slides back where you have the, you know, how we invest and other, yeah, that one.
Yeah.
What are the other, you know, what's OCIO/discretionary?
We love acronyms in this.
Yeah, and I'm out of those.
Yep. That's
But
stands for Outsourced Chief Investment Officer. That's a relationship where the Community Foundation would set forth an investment policy, and basically hand the keys over to the advisor and say, manage it. The committee's a little less involved with asset allocation, with manager selection, and the advisor will make some tilts in the portfolio from time to time based on opportunities. The belief there is because the Community Foundation only meets 4 times a year, that you could be more active in making decisions. Here's the flip side of that argument, and I will tell clients this all the time. 8 times out of 10, the best decision is not making a decision. Not getting caught up in the euphoria of the markets, staying true to your approach, staying true to your asset allocation, and not making knee-jerk reactions, rebalancing. You do that. We do that when cash comes in to the Community Foundation or cash comes out for grant distributions. So that's the Outsourced Chief Investment Officer. And then some of the other, no consultant. It tends to be very large community foundations with $1 billion in assets where they may have an internal staff managing the portfolio. And then hybrid, like everything in life, we have to throw in hybrid. Something that has discretion and non-discretionary combined. Perhaps the advisor is doing more of the back office work for the Community Foundation.
Okay, thanks.
Another question.
The strong trend towards the OCIO, is that you're explaining that people think that you need to be more proactive?
Yes. There clearly, and we talked about this yesterday on our webinar, there clearly has been momentum going back to the inception of the survey in 2016 to now. With that said, what you have is still supported by roughly half community foundations. And we did see this number level off this year. That 37 remained 37 this year. It's a great point. It's one to look at that. Does the model provide better performance? And that is a TBD. Other questions? And again, these are all topics that your board, your committee discuss. All right, speaking of the committee, the role of your investment committee. So you start with just the mission of the Community Foundation. And the committee's role is monitoring and approval. So they set the investment policy statement, and the asset allocation. On an annual basis, typically at the winter meeting, we review an asset allocation study with the Community Foundation's Investment Committee. The study looks at our forward-looking expectations. What do we expect stocks to perform over the next 7 to 10 years? Bonds, cash, and the various sub-asset classes. And then we either ratify or change the asset allocation. The last time we changed the asset allocation was about 2-3 years ago. Got a little more focused on US equities, and that was just perfect timing, even though we don't market time. It was perfect timing. Additionally, then that document is reviewed by the committee and then goes to your board for approval. Quarterly, we provide performance reports to the investment committee. How did you do? The report card, call it. What worked, what didn't? Where's the asset allocation at versus our targets? And any type of changes that we need to make to the underlying investment managers. We typically have a quarterly education piece. This past quarter was on tariffs, just given what was going on. The quarter before was on US exceptionalism. The US has outperformed for 10 years. Should we expect that? AI is such a big part of the economy, the markets, diving down deeper into that topic. We also then, the committee approves the managers. So the way to look at that is FEG is the advisor. FEG then recommends investment managers. So think of mutual funds, ETFs to the committee, and the committee ultimately either approves or asks us for additional information on the managers. And this is the most important. It's just providing that fiduciary oversight of the entire investment program. So from a fiduciary standpoint, you have FEG, you have the investment managers, you have the investment committee, and then ultimately the board of the Community Foundation. So that's the structure and the role of the investment committee. So going back to my comment on asset allocation and what we're trying to achieve, over time, it's that return that's greater than spending, inflation, and your administrative expenses. From a spending policy standpoint, we use a smoothing mechanism in your portfolio. We take a rolling 12-quarter market value of your fund. And for non-scholarships, that's at 4.75. For scholarships, we're still at 5. Why do we use that smoothing mechanism? Where we're trying to reduce the volatility in year-to-year spending. So if you have a down quarter or even a down year, you have the other quarters to help offset. Likewise, if the market is just ripping up like we saw the past 2 years, you're actually spending a little less. Your effective rate is less because we're trying to reduce that volatility in the underlying spending. All right, asset allocation. FEG views asset allocation through 4 broad categories, and you have allocations to 3 of them. Global equities. So this is stocks. Includes US, international, emerging markets. It includes very large companies and small companies. So diversified by geography, diversified by region, diversified by style, and diversified by market capitalization. The purpose of equities is this is where you're going to achieve the majority of your long-term performance. The risk, clearly, a stock market decline. The second asset class is bonds. So fixed income in the portfolio to provide deflation protection, or deflation protection and total return, that equity market mitigation. The risk is rising rates. Real assets. This is where we get some inflation protection. The risk is more deflationary environments. We'll go shortly here and I'll show you how you're invested at the end of the quarter on these three asset classes. But the takeaway is the majority of your assets are in equity-like securities. And this is the last part of this section. And looking at investment managers, there's a lot of detail here. Won't go over it all. But this is what FEG looks for in an underlying fund that we are recommending to you. So we have index funds, and then what we title active management. Active management goes through this rigorous 6-tenet process before any investment manager becomes on our recommended list. We go out to their office, wherever that may be. We meet with various forms of management at the company, from portfolio managers to the compliance officers, to the CEO, controller, really get an understanding of that investment manager. And of those 6 tenets, 4 of the 6 are qualitative in nature. Then risk control. We believe if you have those 5 tenets, you'll ultimately be rewarded with active return or performance above a benchmark. Before I get to performance in our outlook, let me stop there and see if you have any other questions. Yes.
Can you go back to this?
No reason to be sorry.
Spending chart, we talk about spending. I understand inflation administration. Can you explain better what spending means in this context?
Yep. What spending means in this context is the actual dollars being granted out by the community foundation. So if you have a fund here, that's the actual dollars that you are granted. Or if you're an agency fund, like what you receive.
We have a question from Zoom.
Oh, excellent. Look at that, interactive.
I would like to know, would you refresh my memory and indicate how many are on the C3F investment committee and the frequency of appointment and process of appointment and how the chair is selected?
That's a deep question. Probably one more for Sarah and Matt and myself.
Yeah, I'll see if this one will work for a minute. So the average, like the amount of time they can spend on the committee is in 3-year cycles, and they can spend 2 cycles on that. So a total of 6 years. And then the chair of the committee is the treasurer of the foundation.
And we separated, I'll try and use a loud voice, I don't have one. We separated investment and finance a number of years ago through bylaw modification, because this is such a specific set of skills. And so we've actually just reviewed this committee structure and process.
5 members. We're aiming to have 6 total, but of all of our committees, this might be the most difficult to get members onto, just because it requires a certain level of understanding of investments, but also, wary of conflicts of interest as well.
Jeff?
I might also add too that while the information on the investment committee shows that we meet quarterly, the flow of information to investment committee meetings is far more frequent from Matt and from our partners on a monthly basis. We're reviewing stuff monthly. We don't just show up every 90 days and say, oh, what happened? There's a flow of information and natural cadence that happens on a monthly basis. So we are keeping an eye as a committee on those things more frequently. And if there's anything popping up with Jeff or Matt in the interim, know that we're watching the tail on that, so.
And another example of that is we provide flash reports on a monthly basis outside of the quarterly cadence. Just sent one yesterday. Looked much better in May. Thank you for the question online. Any others? Wonderful. Yes.
So how do you make a decision between an active managed fund versus an index fund? And does the underlying charge that, you know, the two, does that factor into it, or is it just like return between the index and the active?
Yes. We have a balance of active and passive. We are passive in the asset classes where it's been extremely difficult for active management to outperform. Large cap US stocks, mid cap US stocks. We're index. We get the cheap 2 basis point S&P 500 exposure and typically call it a day. It's hard for a large cap growth or a large cap value manager to outperform. What do they know about NVIDIA or Microsoft or Procter & Gamble that someone else doesn't know? We then utilize called our fee budget in small cap, international, fixed income, areas where active management has a much better success rate or batting average to be active. So overall, when we look at the total fees of the community foundation, we're right around the 40-ish basis points range. And it is a discussion that we have, and it's based on our recommendations of let's do a balance. We don't think you're either 100% passive or 100% active. We believe in both and focus the fees on the asset classes where you've been compensated. Another way of saying, I don't mind paying 0.8% for a small cap manager if he or she is outperforming the benchmark net of all those fees by 1%. And that's what you experienced. So it's a debate that the last 10 years, especially in large cap US stocks, that has favored passive strategies. Does everyone know what that is? So just buying like a Vanguard S&P 500 index fund like you have in the portfolio. And please keep the questions going. This is awesome. Anything else? All right. Performance, outlook, what a quarter it was. Again, I go, and this is first quarter, so first calendar quarter. I go back to why we stay diversified. The S&P down 4.3. What had been dominating? The S&P. You saw that flip during the quarter and flipped quickly, where the international benchmark for developed countries that we utilize, the EFA, Europe, Australia, Far East, that was up 6.9%. Very different to what we had been experiencing. So we said diversification was in bloom. This was our spring theme. The US dollar. So when you take performance in international equities, one of the components of them underperforming the last 10 years is the dollar has been favored by investors. You saw that just drop off this year with all the tariff announcements and rhetoric. So investors, I wouldn't say fleeing the dollar, but putting the dollar under pressure. I think by the end of the meeting, I might have this clicker figure out. So who's all heard of the Mag 7? The Magnificent Seven, all the large companies of NVIDIA, Microsoft, Tesla, et cetera. What had been outperforming was the Mag 7. Look what they did during the first calendar quarter. Down 16. The rest of the 493 stocks in the S&P 500 were actually up. What's happened since the end of the quarter? Back to the Mag 7. Now it's not all of them. It's more NVIDIA and a few others, but the Mag 7 back to outperforming. Again, why we have indexing such a big portion of your growth component in large cap US stocks. Tariffs, the political football that they have become. It's hard to keep up. As soon as we put a presentation together, it was outdated. You just saw yesterday with announcement with some agreements on the trade front with China. When we look at history, tariffs tend to act like a tax. And just the tit for tat going back and forth that we saw negatively impacted the markets. Where will we end up? Who knows? But the amount of tariffs from Liberation Day, when it was looking like 600 billion, has been cut down to about, call it 200 billion-ish, a little more manageable. Thus, you've been seeing the equity markets come back since that, call it mid-April pivot, and then once we started to see some agreements. All right, performance. This is at the end of March. Go back to this chart. Keep in mind, during the quarter, the S&P was down 4.3. Your portfolio during the first calendar quarter was down 1.4. So diversification, having assets outside the S&P 500 helped. Longer term, 5-year, and this is what we like to focus on. Your portfolio, net of the investment manager fees, up 12.7%. Then we benchmark you. This benchmark, this balance index, as detailed right here, is what if we just took your asset allocation and indexed it all? What would your performance be? We had no active management. You can see the active management, and this is an annualized number, so it's per year. Over the last 5 years, net of fees has added just about 1% or 100 basis points. Yes.
Could you go over the balanced index a little more? And could you also compare the performance to other common indexes?
So the balance index drills down to how the asset allocation is. So going back to my comments of what's in the policy statement, we have 37.5% in large cap US stocks. So we utilize the S&P 500 for that allocation. We have 12.5% in mid-cap US stocks. So we use the Russell mid-cap for that allocation. We have 12.5% in small cap US stocks. That index is the Russell 2000. And then et cetera. So 7.5% for international developed, 2.5% for each small cap international, emerging markets, and then the bond exposure and real estate exposure rounds out that benchmark. Other indices, we can use broader indices, but another item that we benchmark you to is this FOG return. What does FOG mean? It is the Fiscal Officers Group for Community Foundations. I think I messed that up, but somewhere along the lines. It's what are other community foundations returning? I always urge caution when you compare yourself to others. Because of my comment, you've seen one community foundation, you've seen one community foundation. But you're up 12.7 the last 5 years. The average community foundation is up 11.6. 7 years, you're up 7.6. The average community foundation is up 6.9. 10 years, you're up 7.3. The average community foundation is up 6.7. Another way of saying you have consistently outperformed the average community foundation return over the last 5 to 10 years. That is what we call the main pool. At the end of the quarter, so the end of March, the assets were sitting at 55 million. About 5 years ago now, we put together an ESG pool. ESG means environmental social governance. We did this for some of your funds that are more environmental aware. Clearly, the ESG world has become another political football. You are seeing some rebranding going on. Some people call it values aligned investing now. Others just call it responsive investing. So your ESG pool, sitting just a little north of 2 million. Performance ebbs and flows with the technology sector and the energy sector in ESG. What do I mean by that? You tend to be overweight technology in ESG and underweight energy and utilities. The past year's been a little more challenged for energy and utilities. Thus, the ESG pool has a higher return than the main pool. Look at the last 5 years though. Amazing to see those two numbers essentially right on top of each other. So you offered those two pools, and that's what we typically see with community foundations of your size, a main pool, perhaps a cash pool for just liquidity management, and an ESG pool. Questions on the two pools? So then I have here what's worked over the last year and what didn't work. This is the relative performance, more about the active managers. Large cap value, we do have some dividends tilt that help. International small cap has been one of the best performing asset classes. A little lesser known asset class. Fixed income and treasury inflation protected securities. That's helped that relative return over the last year of 10 basis points net of fees. What didn't? Some of our active international developed, although that has come back into favor here so far during the second calendar quarter, emerging markets and US small cap growth. As an example, for the 1 month period in May, the portfolio was up another 4.4% net of fees. So just excellent absolute performance given the rebound in the market and given the diversification. International small cap still outperforming the US market. Asset allocation. Our targets across those three asset classes were 75% in US equities, 20% to fixed income, and 5% to real assets. And in real assets, we are utilizing real estate investment trust. Our current weights, typically right at the targets, just given the run that we've had in equities, we're a little over our target. And then when we need cash for distributions or grant payments or for administrative expenses, we will take from the asset classes that we're overweight. But our short-term outlook is essentially neutral across the major asset classes. It is difficult right now to bet against the Mag 7. It's still where most of the growth is here in the US and internationally. While the international markets have had a very nice run, growth rates, expectations still are much higher in the US. The issue we have in the US market is valuations are stretched. So typically, when valuations have been this stretched, the ensuing 3-5 year returns are low single digits. So think of the US, better macro growth, but valuations, the price you pay, which ultimately does matter, is high. International, on the other hand, valuations are much more attractive. They've been out of favor for 10 years, but growth rates are still rather anemic. So just a slight overweight to equities. And with that, we are over to US equities. Yes, Perry.
Do you have a thought about why the performance has been low in the small cap, the US small cap?
So small cap's been out of favor 10 years. There is the issue within small caps. It's really threefold. Number one, they haven't termed out their debt like large cap companies, and that's typical. So when they're refinancing, it's at much higher rates. So you have that interest rate sensitivity to where yields are at. So that's one. The second, I would say, is more the indices. Over 45% of the Russell 2000 index does not have earnings, or earnings are negative. So you have termed out debt at higher rates, earnings that are not strong, especially compared to the large cap companies. And then the third part's a little nuance of just the IPO market. The IPO market has been rather lackluster, and that usually refreshes the index. When you have newer names going IPO and coming, they typically are smaller cap companies. So you got a triple whammy, call it, versus large caps. Now, what does give us some optimism is that valuations in small caps as compared to large caps are more attractive. Also in the cycle, small caps tend to outperform coming off market bottoms or out of recessions or out of bear markets. And we just haven't seen that, especially coming off of those mid, call it April lows. It's still the large caps that are performing better than small. It's a very unique time period. So back to the asset allocation. Our outlook is one of cautious optimism. Cautious on just the overall impact of tariffs, the volatility, what that might mean for the job markets. Optimism, growth still in the US is stronger than international. The consumer continues to spend. The unemployment rate sitting at 4.2% is relatively or very strong, but there are some signs, some pockets, call it, of concern within the employment numbers. We haven't talked about interest rates. The bond market, the 10-year treasury sitting at 4.3, 4.4%. At some point in time, we'll look at increasing our fixed income exposure back to target. It just, yields are bouncing around. Where we end up on inflation and the whole discussion, debate over the Fed cutting rates remains to be seen. You know, clearly, Chair Powell believes that tariffs could be inflationary, and the president thinks otherwise. So right at essentially our long-term targets of 75% equity, 20% bonds, 5% real assets. Questions, comments? Very last chart, and this is within our asset allocation study, is just our 7 to 10-year capital market assumptions. And the takeaway from here is that equities, we're looking at 6% roughly in the US, international a little higher, bonds around 4.5. We do think it's going to be challenging to get us to that absolute return, call it target of 7.5 to 8, 8.5. But the beauty of foundation investing is the whole perpetuity component. For good, forever. You can withstand the volatility that the markets present on a daily basis, and we are staying true to our long-term approach. Yes.
We have a copy of your presentation.
Yes, sir.
Yeah, we'll be providing a copy and a recording of the presentation to everybody, so that'll be in email at some point.
Other questions? Well, I will be around here till we leave for lunch. We're going to enjoy the outdoors on this beautiful day. Yes.
So do your programs and or the community foundation do any investment education starting, I don't care, in kindergarten? I'm serious, like part of investing now and forever is teaching people investing now and forever and incorporating that to get more people interested in donating for community foundations, but helping in that education.
Yeah, not formally. There is a program in Michigan called Learning to Give, and it's a philanthropy curriculum overall. It does include elements of endowment and giving back, you know, some of these sort of fundamental concepts. Our youth advisory committee has been engaged in their local schools, not so much focused on investment necessarily, but more on the concepts of, you know, that the community foundation stands for. So a little bit, there's opportunity there, and fortunately, we have a very strong staff person in that space. Megan works with our YAC, and Learning to Give is a curriculum that's available to us in the state of Michigan. It's through Council of Michigan Foundations has Learning to Give as a child program.
I think you bring up a great point though, just on financial literacy. It's
A real issue.
It is a real issue, and we need to start early.
Yeah.
And before high school.
I had somebody, actually, when I was at the Women's Resource Center yesterday, a woman talking about a program that's, you know, starting in pre-K and doing little practice credit cards and helping kids learn, you know, return on what they're buying and stuff. If it's buying Cheerios, but if you use too much, but learning financial responsibility, I think that's a weakness in our school system. And I think it reflects.
I concur, because you also see the data, just, I mean, for like 401k plans of starting early, right when you
Right.
graduate and get your job. Because if you miss those first couple of years, and just the powers of compounding,
Absolutely.
and we totally whiff on that as a nation.
Yeah.
Or even earlier, starting a Roth IRA.
Yeah.
When you've got teenagers working.
That's right.
Exactly.
Well, my boys just started working the past few years, and so we've we've maximized what we can with those. And I did a little extrapolation. I showed my son how much, even if we just put $100 in today, in 30 years, he said, wow.
You could retire.
Excellent point.
Well, if there are any more questions, and this will be cutting in and out, I want to thank Jeff for coming. Can we hear it for Jeff? Thank you.
Not hard coming up here in summer.
Yeah, yeah. Enjoying a nice lunch outside, which would be great too. Thank everybody for joining via Zoom and spending the time here with us again today. We'll be hanging out here for a little bit, so please enjoy some more pastries, some coffee, tea. We have water, and we look forward to talking to you. Thank you so much.
Thank you.